some people would often say, well, do I pick either dividend investing or do I pick growth investing? And they're trying to figure out which one is best for them. So today, let's talk about that. Should you invest in dividends or should you invest for growth? Hi everyone, welcome to Market Monday. It's the last day of the month. Woohoo! Thankfully, the market is actually rallying today. It's up. I'm really happy about that. It's a green day, so it means finally some, increase in my portfolio. So yeah, and I hope it's the same for you if you're investing. That's why it's very important to stay invested during market corrections and red days. Because if you sell, you'll miss days like today where the market is actually quite up. Awesome. So today I want to talk about dividend investing versus growth investing. Now you may be thinking, what does that mean? If you've been investing before, then you've come across this terminology of dividends versus growth, or these two, ways of investing. Well, I'm just going to break it down very, very simply to you today. Well, let's start by defining what dividend investing is. So basically, whenever you invest in a company and the company makes profits, right? So you buy shares in the company uses that money to, grow their business, and then they make some profits. They have to then decide what they do with that profit. Do they give it back to you in cash form, or do they reinvest it back into their company to grow it to increase the value of the shares? It's all determined by profits and what is done with the profits. With dividend investing, the company pays you back every profit they make, or a percentage of the profits that they make, as dividends. Okay, so you're earning this money on the stock. Whereas with growth investing, the company pays you back by reinvesting in the stock and increasing the value, so it increases. Another way of thinking of growth is called capital gains, so it increases in value. Okay, so let's make it a bit simpler. Let's say you bought a house. Okay, if you rented that house out and the person is paying you monthly rent, that's a kind of dividend. Okay, now if the house you bought it for 100,000 and it's increased in value to 120,000, that is capital gains, that is growth. So now the value of the house is more, but you don't get that cash, that increase, that extra 20,000 from 100 to 120. You don't get that 20,000 unless you sell the house. That's called a realized capital gain. If you don't sell the house, it's called an unrealized capital gain. Okay? So, how does this apply to stocks? You have to think of stocks in the same way as you think of a home, because it's an asset, it's a financial asset, whereas houses and buildings would be real assets or real estates, right? So it's the same principle. You invest in Apple, you buy a stock in Apple. Apple decides, okay, we are going to pay you a dividend, or we are going to invest and grow the company, and then the value of your shares increase. So which one should you do? That's the big question we're going to answer today. So first of all, let's talk about what kind of companies tend to pay out dividends. The companies that pay dividends tend to be companies that have been around for quite a very long time. So they've grown over several decades and they've achieved, a huge market share. So they are very popular, they're very well known. Let's talk about Coca-Cola, for example, if you're thinking of a company that is a solid dividend company. So Coca-Cola is known in over 200 countries, right? They're making billions every year, right? They sell about 1.9 billion or 2 billion products every year. So they've been around for a while. Everybody knows them. Like, the chances of them increasing their market share by 20% or 50% is very low because they are already everywhere in the market. So the market is saturated with their products. So now what they do is they pay you their profits as a dividend. They are a stable company, and companies that tend to pay dividends tend to be very, very stable. They've been around for quite a long time. So think companies like banks, consumer staples. So like Johnson & Johnson, Procter & Gamble, companies like that, like PepsiCo, Coca-Cola. Those are very stable companies. They've been around for a very, very long time. Now, if you begin to invest in dividends, you hear some terms like dividend aristocrats and dividend kings. Dividend aristocrats are companies that have been paying a dividend consistently for the last 25 years, okay, or 25 years or more, whereas dividend kings tend to be 50 years or more. So now the other side of it is growth companies that grow and you get capital gains. So they don't necessarily pay out a dividend, or some of them pay a very small percentage in a dividend. So let's talk about growth companies. These tend to be new, innovative companies. Think like Tesla, right? They need cash to gain more market share. They need to grow, to establish themselves, to become profitable, where they are well known in the market, they are making a lot of income, and their revenues are really, really impressive. They are making more profit than loss, So think of companies like Tesla. Right now, it doesn't make sense if Tesla is paying you a dividend, because they can use that money to grow their company instead of giving it back to you. So how does Tesla pay you? With the profits. Remember, it's all about profits. Instead of giving you the money back, they reinvest it into the stock. So if you bought Tesla for $100, then it grows to like 120. That extra growth comes from the money that they made, the profits reinvested back into the share, and it makes it grow. Okay, so a company like Coca-Cola pays you a 3% dividend. So if you spent $100, they pay you 3% of that, which is $3. So a company like Tesla will not pay you a dividend. However, the value of the shares will grow. Now, here is where it can get a bit complicated. Most companies that pay a dividend also still grow. So if you are thinking about investing in dividends, it doesn't mean that the share price will not increase. It just wouldn't increase at the same pace as one that is not paying a dividend. Okay? So it's not going to grow as fast as one that is a newer company and is, growing by 10%, 20% every year. Okay? But it doesn't mean that you will not make money. It just means that you're earning most of the money that they make back as dividends. So there are some companies that do both. They pay a dividend, but they are also growing. So these are called dividend growth companies. Okay? Classic example of this would be Apple and Microsoft. So Apple, for example, pays a dividend of about 0.5%, but they grow every year. So over the last 10 to 11 years, Apple has been growing by over 30% per year. On top of that, they pay you a dividend, but it's a small percentage that is paid as a dividend. But that percentage increases every year. Think also of a company like Microsoft that pays about 0.8% dividend. They've also been growing at quite a good rate, but they've started to pay a dividend, and it's 0.8. It's small, but the share price increases over the years as well. Now, if you are in a country like America where dividends and capital gains are taxed, then you can sort of try to decide which one you want to do. But in Switzerland, it is not very tax efficient to invest in dividend stocks. The reason being, in Switzerland, your dividends will be taxed at the ordinary income rate, which is about 35%. Now, when you do your taxes, they will calculate it and they can give you some of those taxes back, depending on your income. However, it's not very efficient, because you have to first, declare it. It's called a withholding tax of 35%, and then you may get some of that back and all of that. So it's not the best way to invest, right, in Switzerland, especially if you're a young investor and you have not retired yet. So in Switzerland, the best way to invest is for capital gains, because as long as you're not a professional investor and you are holding, the stock or the company shares for 6 months or more, any percentage it grows by any capital gains is tax-free. So which would you rather? Paying taxes on it or not paying taxes? I would rather not pay taxes because I'm already paying enough taxes, I think, anyway. And since I don't need the money at this moment from the stock market, I'm in the accumulation phase where I'm investing, not drawing down. It makes more sense for me to just keep investing in companies that are growing, not necessarily paying me back. Now, some of them will still pay you back a little percentage, but it's very small. You just reinvest it back. It's called DRIP. So you reinvest your dividends to get more shares over time. So dividend investing, in essence, in summary, is better for people that are retired or people that depend on the income from the stock market. Whereas capital gains investing or growth investing is better for people that have a longer time horizon. They're not pulling on the stock market yet. They're not pulling on their portfolio, So you can let it just grow and ride over time. And in Switzerland, capital gains is best, especially because of the taxes. Now, if you retire and you can switch from, growth stocks into dividend stocks. Now, you may be thinking, well, I don't have individual stocks. I have ETFs, so an exchange traded fund. Some of those funds will still pay a bit dividend because some of the companies in the fund pay dividend. So, for example, VUSD, which is the Vanguard S&P 500, very common here in Switzerland, pays about 1.07% dividends. Which is not a lot, but it's a small amount, and you can reinvest it back into the ETF or into the fund. So, in summary, if you're a young investor, you've got a longer time horizon, and you live in Switzerland, capital gains or growth investing is far better for you. It's more efficient for you. But if you are a retired investor, or you're going to retire in like a year or in a short time, and you're going to need that dividends to live off, or you're going to need it to pay for your everyday expenses, then dividend investing is probably better for you. Because once you stop working and you retire, your income drops, right? So now, even though you're drawing on your portfolio, it's not going to increase your taxes by much. Okay, so I hope you found a lot of value from that. Please subscribe, like, and comment, and share this with your friends. And also join our Facebook group, Financial Freedom Switzerland. Join, it's amazing. We share lots of content there every week, and if we have webinars upcoming, I always post it in the group as well. So I hope you have a lovely week, and let's hope that the first week of February from tomorrow that the market stays green and we can all be happy. Awesome. Thank you, and have an amazing week. Bye-bye.